Hello everyone, welcome to part 3 of our discussion of chapter 10, and here we're dealing with some other gains and losses that are perhaps not recognized because of the rules. All right, so one of them that we need to be aware of is we don't get to recognize losses when you sell. Remember, you can generally have losses on business or investment property, but not when you sell to a related party. The idea is you could create a loss, meaning you have property, you want to recognize a loss for the year to offset some other income, so you sell to your brother at whatever price you agree, which could be well below what it would actually sell to someone else. Therefore, you recognize the loss, but you get to still use the property because it's your brother, that sort of thing. So that's not going to work. So if you sell to related parties, you don't get to recognize the loss. Example, fair value $5,000, purchase it for $9,000. Okay, so in this case, they're not trying to abuse it, but the rule still applies. You don't get to recognize the loss, and the basis carries over. So now the brother has basis of $5,000 in the stock because that's what he paid for it. All right, when he sells it for $12,000 later, he can offset part of his gain by, his guy the $7,000, but he can reduce that because of the $4,000 disallowed. So he gets some benefit of that if it happens later. So this is to mean that if you didn't do it because you are trying to avoid taxes, you just did it because that you literally did want to transfer the stock to your brother, then that loss does get to be used later on. Okay? Example 2, same scenario. Sister sells stock for $8,000. Okay, her basis was $5,000. Remember, because she got that's the fair value. That's the what she paid for it. She can offset that disallowed earlier loss against the $3,000 gain to zero. But remember, the disallowed loss was $4,000. The other $1,000 is lost forever. Okay, so there is still, it can't create a loss for the sister. It can only make it a zero. This is very specific stock that as sold, you get to exclude a portion of the gain realized. It has very specific requirements, and we're not going to spend a lot of time on that. Okay, like-kind exchanges. These rules are mandatory, meaning if it is like-kind property, you have to postpone both losses and gains. So of course, postponing gains is a good thing. Postponing losses is a bad thing. So you never want to do a like-kind exchange with property that has a loss. Okay, so the basis is carried over in the like-kind exchange. So your basis in the property is the fair market value of the new property plus postponed loss minus postponed gain. And this should only be postponed gain because, like we said, we should never do like-kind with a postponed loss. And then you have the basis of the new property. What is like-kind? Under the current law, it is only real business and investment property. So only land, buildings, that sort of thing. And it has to be either business or investment, not personal, not your house, not vacation home, that sort of thing. It can be a direct exchange, but it can be deferred. It can be different timing. And the foreign property isn't going to work for like-kind. It has to be inside the United States. Now, when you have two properties of unequal value, then you may have to make up the difference by some kind of other asset. that's called boot. Whether it's, most of the time it's cash, but it could be something else. It could be inventory, it could be a car, it could be something that is not like kind. That all of those are considered boot. If you receive boot, you may have realized gain from the like kind, okay, that needs to be recognized. So the boot, if you have a truly like kind exchange, no cash, no boot exchange, then you're not going to have a recognized gain. But if there is some boot, then you could have a part of the gain recognized. And even giving boot can it recognize gain if the asset other than cash that you give up has a different value, has a gain built in as well. So example is the best way to understand this. Okay, Sam exchanged land for $50,000 for Jane's land worth $40,000. So they each have land they're willing to exchange, but the problem is one's worth a little bit more than the other. So Jane's going to pay $10,000 of cash. So Jane's giving boot, Sam's receiving boot. All right. Now, when the boot is cash, the only way you could have a gain is if you receive the boot. Okay, and in this case, the cash. So let's look at Sam. Sam realizes $40,000, the land he gets, plus the $10,000 in cash. All right, and then his basis is 36, so his realized gain is 14. All right, but his recognized gain is the 10,000 boot received. He can only has recognized up to the amount of the boot, and this time cash. So his new basis in the new land is his fair value of the land he received, the 40,000, minus the postpone, right? Because he had a realized gain of 14, postponed 10, recognized 10, I should say, and then postponed the other 4. So his basis is 36 going forward. Now Jane, basis is 65. Now this is the kind of situation you shouldn't do because her realized is a loss, okay? And she recognizes none of it because it's required that you, on a like kind exchange, that you do so. And so her basis in the new land is $50,000 she got and the $25,000 postponed loss. Okay, similar situation. Diane realizes we got no boot, so she recognizes no gain, and all of the gain is postponed, and so it reduces her basis going forward. Earl realizes a gain. He gets the recognized gain is $3,000. Why is it all? Because his boot actually exceeds his realized gain. So it's all realized. All right? And so his basis, there's no postpone, so it's just $50,000 for the land that he got from Diane. Sale of principal residence, special rules, $250,000 if you're single, married up to $500,000 exclusion. This basically means that anybody selling their principal residence is going to not have to include the gain on their tax return. As long as it's been used for 2 of the previous 5 years, which is pretty easy standard. If it's not, then you could take just part of the exclusion based on how much you used, and still, if you start with a $500,000 full exclusion, even if you have part of it not used, you still could end up with a several $100,000 exclusion, which should take care of most of the gains on your house being sold, unless it really jumped up in value. Involuntary conversion. This is where you didn't mean to sell your property, but something happened to it, and what happens is you got an insurance or someone or something came along and paid you insurance, which means you converted your property into cash involuntarily. Okay, this would also happen when the government condemns your property. This is treated in many ways like a sale, in that you receive cash in the form of an insurance settlement, as like you sold it, and you compare that to your basis in the property. Okay. Gains, and what we're worried about is gains. If it's a loss, that's just what we expect, and that's what you're going to, depending on the situation, if you'll be able to deduct that loss. But gains can be postponed. The idea being that you're going to use the insurance proceeds or the money you received for the property, because you didn't want to sell it, and use it to buy new property or rebuild or whatever. If you receive cash, it's elective, which most people are going to, and if they replace the property with another property, then of course it's like a like-kind exchange and it's mandatory. So again, the cost of the replacement property minus any postponed gain equals your basis. So the cost of the replacement property would be the same as the fair market value. So this is very similar to a like-kind exchange. So what is it you have to replace it with? It has to be similar to what you had before. Okay? The property has a similar any service or use. If it was used in a business, it's got to be business. If used for investment, it's got to be investment. You got a little bit of time. You can't take forever. You got 3 years. If it's condemned, and everything else is 2 years after the year which it gets converted. So, case land is condemned by the government on October 5th. Government pays $75,000. Their basis is $34,000. So we've got a realized gain of $41,000. You can postpone all of it if she purchases investment realty costing at least $75,000. So she's got to spend all of this $75,000. Think of it, if she doesn't spend $75,000, she only spends $70,000, then she received $5,000 of boot, if you will, like a like-kind exchange. And so she would have gain to the extent of the cash she did not spend on the new property. If she spends it all and more, then she doesn't have to worry about any gain. It can be postponed at least until she sells the replacement property. Okay. Here's another example. We've got a $70,000 realized gain. And this, because it's not a condemnation, he's got 2 years to make the purchase. He's got to spend $210,000 or more. If it's less, then he received boot and he could have partial gain. Federally declared disaster, you get a couple extra years if it's your main home. So it just gives you more time. So the point to remember is you've got to spend the money in an involuntary conversion on property that's used similarly. If you do that, then you postpone the gain. Now your basis in the property is going to be just like a like-kind exchange. It's going to be the fair value minus any postponed gain, any that you didn't have to recognize because of that you spent the money on replacement property. That concludes Chapter 10 discussion.